All right, after enough talk, last week the Federal Reserve cut interest rates. Here's what it means to you. Let's get into it. So, the Federal Reserve has this dual mandate of managing price stability and maximum employment, meaning they got to manage both inflation and the labor market. When it comes to inflation, it's not where anybody wants it to be, but we've made improvements. It's better than it was. As for the labor market, that's been showing signs of deterioration. So that's what led to the Federal Reserve saying we should cut rates because, okay, maybe the economy could use a little help. Maybe money could be a little more available. So in efforts to loosen this monetary policy, the Federal Reserve, our central bank, lowered interest rates by 0.5%, or what you at home might be hearing referred to as 50 basis points. This is the first rate cut since 2020, the largest one in 16 years, and it was done to make lending money cheaper. How that's done is the Fed adjusted what's known as the Fed funds rate, which is the rate that banks loan to each other and then banks loan to us, the consumers, in the form of mortgages, credit cards, new car loans, personal loans, etc. But what that means to you is that if you have an existing mortgage or a car loan, you're not going to see your rates change. But if you have an adjustable or a variable one, you'll see those rates come down. Now, if you're looking to get a mortgage, you've already seen mortgage rates come down from 7.5% 8 months ago to just over 6%. So mortgage rates, credit card APRs, new car loans, they're coming down. The flip side of what we're seeing with these low interest rates is that money that you've been earning in the bank, those high yield savings accounts, CDs, money market accounts at 5+% that everyone's raved about, those rates are going to come down and the money that you've been earning in the bank will be lessened. So while borrowing money becomes cheaper due to a rate cut, actually saving money in the bank, you just don't earn as much. As for the implications in the stock market loves rate cuts, and rate cuts like this are just going to fuel it. As money becomes more readily available or cheaper, you should see the stock market react well to this, especially sectors like banking and real estate that are a little more interest rate sensitive. So though this is an aggressive rate cut, the biggest one we've seen in a long time, more than most expected, that's how it impacts you and your money. Thanks for tuning in. Catch you guys later.